Hello investors, I'm Stuart Kruse and welcome to Kruse Asset Management's video chart of the day. As you know, Kruse Asset Management is a quant shop, which means we make our recommendations based off a numerical analysis. Part of that numerical analysis can be statistical and fundamental. Part of it can be technical. Fundamentals are things like company operations, earnings per share, profit margins, those kind of things. Technicals are nothing more than the patterns a chart makes or some ratios within a chart. So we're going to talk about some technical ratios for the S&P 500. So we will, without further ado, we will go to our chart, Y charts, and up on the board I have the S&P 500 price chart. This is a 10-year price chart. And as you can see, we are marching higher, higher, higher for quite some time. I am going to put on the 200-day simple moving average. And as you can see, the 200-day moving average is in orange, and we've gotten well above our 200-day simple moving average. So I'm going to put a ratio up here of the S&P 500 and the ratio of the S&P 500 price level to the 200-day moving average. And as you can see, this is kind of compressed. We're at 14% above our 200-day moving average. So if I just make it this chart, you can see over the last 10 years, we are higher than at any other point except for right here. We've only been at this point one other time in history. So what does that really mean? Well, I'm going to bring back the level again so you can kind of see this. Whenever we hit these high levels like this peak right here, we tend to have a sell-off. We hit a peak here, we tend to have a sell-off. We hit a peak here, we tend to have a sell-off over time. So what does that mean? Well, I ran some numbers. I'm going to pull up a spreadsheet right here. And what this spreadsheet says is when we are at 100% or right on our 200-day moving average, the average daily returns have given you about an annualized rate of around 8.5%, which is roughly the S&P 500 returns. So you can see we have some returns as we start getting higher and more extended above that 200-day moving average, these returns start falling off. Now, I wouldn't say sell out of the S&P when you start getting above the S&P 500 200-day moving average, because long-term momentum works. You don't want to keep trading these stock prices. But as you start getting higher, and I'm sorry you can't see this number, this is 108, 109, 110, 111, 112, 13, 14, 15, you start getting average daily returns that have negative annualized returns in the 30% range. We're at 14.2 right now. We've only had one day that was above 15%, and that had a negative 90% return. So what you might want to do is basically buy a put on the S&P 500 to give you some sort of short-term upside or protection on the S&P 500 in case it kind of falls back. So we're looking at being in this area right here. Now going back to the charts, what's even worse, I'm going to look at the QQQs. We're 14% above on the S&P 500. And here's the QQQs. I'm not sure why we're not getting our 200-day moving average above our QQQs, but we need a price on here. So let me give you a price maybe. There we go. So above the QQQs, we are 31% extended above the QQQs. And if we come over here and get rid of these and we look on the Qs, and that's technology, of course, in the last 10 years, we have never been higher than this. I can make this go out maximum. So if we go, we have to go all the way back to the .com bubble and bust before we actually see a number that's more than 30% above the 200-day moving average for the Qs. So even back here, pre-financial meltdown, we weren't there yet. So this got really overextended, but by far well above any other number, okay, on the Qs. So let's also look at the Dow. So here we have the Dow Jones and the level of the Dow. And the Dow Jones, we're not nearly as high above the 200-day moving average. We're only 8% above. But you can see on the Dow Jones and the ratio of the level to the 200-day moving average, again, we hit a high number of around 18%. we don't normally hit these numbers in these 15, mid-teens ranges. So 14% above, here we had 11, 12. So 14% above for the S&P 500 is a high level. And I'm going to, again, go back to this chart. That would suggest that the daily return, the annualized daily returns for the S&P 500 moving forward are going to be in the negative 30% range. Now, I'm not saying the S&P will fall 30% from here. What I'm saying is the daily average return annualized would be down 30%. So put it another way, the odds are not in your favor being long in the S&P right now. And at Kruse Asset Management, we want to invest with the odds in your favor.